Recently, we have seen a surge of market volatility in the stock markets. With CFDs, you can protect your underlying portfolio by placing a short position to profit from a price fall. Perhaps you have a large holding of UK stocks and you're worried that your investment could suffer a nasty fall. Selling up and buying back later might not be an attractive option, so instead you decide to hedge. Here's an example. A long-term investor with a £100,000 diversified shares portfolio during the financial crisis of 2008 could have protected his investment by taking a short CFD trade in the FTSE 100. With the FTSE 100 trading at 5,500 and a margin requirement of 1.5%, this would have needed a deposit of £1,500 in addition to extra funds to account for any running losses. Most CFD providers would equate an index CFD to having an exposure equivalent to £1 per point. So in this case, you would have needed to short about 18 contracts. That's £100,000 divided by 5,500. A fall in the value of the investor's shares portfolio value would then potentially have been offset by gains in the short FTSE position. In this scenario, the objective would be capital preservation as opposed to speculation, or if dealing with a market maker CFD provider, use can be made of the synthetic sector indices, for example the banking sector index, if the portfolio is heavily weighted towards banks. Now, if shares in general were to rise, you would still stand to make money. Whilst a few shares in an index might fall in value, the average performance of the entire index will offset the poor performing equities. Hedging has considerable advantages. Not only do CFD hedges offer protection against the intricacies of turbulent market conditions, but hedging is also a tax-efficient mechanism. That's because there is no possibility of incurring a capital gains tax liability, apart from the consequent gain on the CFD.